Today, I want to talk about one of the most powerful and most overlooked financial tools in Canada, the Registered Disability Savings Plan, or RDSP. If you or someone you care about lives with a disability, this account can potentially mean tens of thousands of dollars in free government money over a lifetime. Yet many eligible people either don't know about it or don't fully understand how it works. By the end of this video, my goal is to give an easy-to-understand overview of what an RDSP is, who can use it, why it's so valuable, and how to use it properly. Let's start simple. An RDSP is a long-term savings account created by the Canadian government to help people with disabilities save for their future. It's not meant for everyday spending. It's meant to create long-term financial security. So who is eligible? You can have an RDSP if 1. You are approved for the disability tax credit. 2. You have a social insurance number. 3. You are a Canadian resident. And 4. You are under age 60 when the account is opened. If the person with the disability can't manage finances independently, a parent, guardian, or legal representative can open and manage the RDSP for them. This makes the RDSP useful not just for individuals, but also for families planning long-term care. Your investments grow without being taxed year after year, which allows compounding to work faster. Now let's talk about government contributions. This is where the RDSP really shines. First off, we have the Canada Disability Savings Grant. When you contribute your own money, the government may match $1 with up to $3. That means a $1,000 contribution could become $4,000 if you are eligible. The maximum grant is $3,500 per year, up to a maximum of $70,000 over a lifetime. Next up, the RDSP gives the Canada Disability Savings Bond. If your family income is low, the government may give up to $1,000 per year, even if you contribute nothing. The lifetime bond limit is $20,000. So in total, with the grants and bonds combined, the government can contribute up to $90,000. There's an important age rule to understand. Government grants and bonds stop after age 49, and you can receive grants and bonds retroactively for up to 10 previous calendar years, as long as you were eligible for the disability tax credit in those years, and you were age 49 or below in the year the account is open and eligible. That 10-year time frame is ticking. That means every year you wait is a year of lost free money. Opening an RDSP early, even with small contributions, can make a massive difference over time. As for contributions, the maximum that you can put is $200,000 over a lifetime, and there is no annual limit. Your contributions are not tax deductible and are never taxed when withdrawn. However, the government money and growth are taxed upon withdrawal of the account. There's one rule you must understand to avoid mistakes, called the 10-year rule. If you need the money and decide to withdraw it, any government contributions made in the previous 10 years must be repaid. This is why the RDSP is meant for long-term planning and is best utilized when it can be withdrawn at age 60. The account is not designed for short-term emergencies. At age 60, the account shifts from saving mode to support mode. Contributions stop, government money stops, and regular payments begin being paid out. To sum it up, the RDSP is one of the most generous financial programs in Canada. It rewards long-term planning, it protects your disability benefits, and it offers a level of government support that few other accounts can match. The RDSP can feel complicated at first, and that's completely normal. If you're unsure whether you qualify or you just want someone to walk through it with you step by step, I'm available to help. My email is in the description below. I hope this video was informative to you. Have a great day, everyone.